Section 6:1 Introduction to Modern Portfolio Theory, Performance Evaluation and Monitoring. 6.1 Performance Measurement. Assessing portfolio performance is crucial for evaluating the effectiveness of investment strategies and comparing different portfolios. Several performance measures, including the Sharpe ratio, Treynor ratio, and Jensen's alpha, are commonly used to evaluate risk-adjusted returns and provide insights into a portfolio's performance relative to a benchmark. Here's an explanation of each measure. Sharpe ratio. The Sharpe ratio measures the excess return earned by a portfolio per unit of risk taken. It is calculated by subtracting the risk-free rate of return from the portfolio's expected return and dividing it by the portfolio's standard deviation. The formula for the Sharpe ratio is, Sharpe ratio equals, portfolio return, risk-free rate, / portfolio standard deviation. The higher the Sharpe ratio, the better the risk-adjusted performance of the portfolio. A higher Sharpe ratio indicates that the portfolio has generated higher returns for each unit of risk taken. It allows investors to compare portfolios or investment strategies based on their ability to generate excess returns relative to their level of risk. Treynor ratio. The Treynor ratio, named after Jack Treynor, measures the excess return earned by a portfolio per unit of systematic risk, also known as beta. The Treynor ratio is calculated by subtracting the risk-free rate of return from the portfolio's expected return and dividing it by the portfolio's beta. The formula for the Treynor ratio is, Treynor ratio equals, portfolio return, risk-free rate, / portfolio beta. The Treynor ratio helps assess a portfolio's performance relative to its exposure to systematic risk. It is particularly useful for evaluating portfolios that are expected to have a significant correlation with the market or a specific benchmark. Jensen's alpha. Jensen's alpha measures the risk-adjusted excess return of a portfolio relative to its expected return, considering the portfolio's exposure to systematic risk. It is calculated by subtracting the risk-free rate of return from the portfolio's actual return minus the expected return predicted by the capital asset pricing model, CAPM, multiplied by the portfolio's beta. The formula for Jensen's alpha is, Jensen's alpha equals portfolio return, risk-free rate portfolio beta, benchmark return, risk-free rate. A positive Jensen's alpha indicates that the portfolio has outperformed its expected return based on its systematic risk exposure, while a negative alpha indicates underperformance. Jensen's alpha is useful for assessing the ability of a portfolio manager to generate excess returns above what would be expected given the portfolio's systematic risk. It's important to note that these performance measures are based on historical data and have their own limitations. They rely on the accuracy of return estimates, assumptions about risk-free rates, and the appropriateness of the chosen benchmark. Moreover, they may not capture all aspects of portfolio performance, such as downside risk or nonlinear relationships. Therefore, it's advisable to use multiple performance measures in conjunction with qualitative analysis to gain a comprehensive understanding of portfolio performance. Performance measures and benchmark selection have certain limitations that investors should be aware of when assessing portfolio performance. Here are some key limitations to consider. Historical data reliance. Performance measures rely on historical data to calculate returns, risk measures, and other metrics. The accuracy and representativeness of historical data are crucial for the reliability of performance calculations. However, historical performance may not necessarily reflect future performance, as market conditions, economic factors, and asset-specific characteristics can change over time. Data availability and quality. The availability and quality of data can impact the accuracy of performance measures. In some cases, data may be limited or subject to biases, leading to potential inaccuracies in performance calculations. It's important to ensure that the data used for performance evaluation is comprehensive, reliable, and appropriately adjusted for factors such as dividends, fees, and other relevant considerations. Benchmark selection bias. Selecting an appropriate benchmark is critical when evaluating portfolio performance. A benchmark should represent the asset class or investment strategy that the portfolio aims to replicate or outperform. However, biases can arise if the benchmark is not sufficiently representative or is selected based on hindsight. A benchmark that is too narrow, unrelated, or inconsistent with the portfolio's objectives may lead to inaccurate performance assessment. Survivorship bias. Survivorship bias occurs when the performance of failed or discontinued investments or funds is excluded from the analysis. This bias can skew performance measures, as underperforming investments are not accounted for. Survivorship bias tends to overstate the performance of the remaining investments. Potentially misleading investors. Backfill bias. Backfill bias refers to the inclusion of historical performance data for investments or funds that were added to a database after achieving favorable performance. Including such data can create an upward bias in performance calculations, as the poor-performing investments that were not added to the database are not accounted for. Backfill bias can result in an overestimation of historical performance, style drift, and changing strategies. Performance measures may not capture changes in investment strategies or style drift. A portfolio manager may modify the investment approach over time, which can affect the portfolio's risk-return characteristics and make comparisons with historical performance challenging. It's essential to consider changes in strategy and investment process when evaluating performance over different time periods. Lack of risk considerations. Performance measures such as returns, Sharpe ratio, Treynor ratio, and Jensen's alpha focus on risk-adjusted returns but may not capture all aspects of risk. Other risk metrics like downside risk, drawdowns, and tail risk may provide a more comprehensive view of risk exposure. It's important to consider these additional risk measures alongside performance metrics. Behavioral biases. Performance measures may not account for the impact of behavioral biases on portfolio performance. Behavioral biases such as overconfidence, herding, or anchoring can influence investment decisions and potentially impact portfolio returns. These biases are not captured by performance measures but can affect investment outcomes. Considering these limitations, it is advisable to use performance measures as part of a comprehensive evaluation process. Qualitative analysis, understanding the investment strategy, risk management approach, and aligning performance evaluation with individual investment objectives and constraints can provide a more holistic assessment of portfolio performance. Additionally, it is recommended to consult with investment professionals or financial advisors who can provide expert guidance in evaluating and interpreting performance results.